Here's a situation that happens more often than people talk about. Someone spends years doing everything right. They save consistently, they invest, they buy a property, maybe they start a business on the side. They open their net worth tracker one morning and the number is real, legitimate, something they actually built. And then something goes wrong. Not dramatically wrong, just quietly wrong. A tax bill they weren't expecting, a deal that didn't work out, a relationship that changed, an investment that was locked when they needed it liquid. And they realize the traps at this level are completely different from the ones they faced when they were starting out. When you have nothing, the trap is spending more than you earn. Simple, obvious, hard, but clear. When you start building real wealth, the traps get invisible. They don't look like mistakes. They look like normal decisions. They look like opportunities. Sometimes they look like success. That's what I want to walk you through today. 7 financial traps that show up specifically as your net worth grows, where they come from, what they actually cost, and exactly how to get out of each one.
Trap 1, overconfidence, and specifically confusing your net worth number with actual financial power. Here's what happens. Your net worth tracker says $540,000. That number is real. You earned it. But look at where it actually lives. $180,000 in home equity. Completely locked. You can't spend it tomorrow. Accessing it means a refinance or a sale. Both take months and cost money. $95,000 in your 401k. Also locked. Touch it to 459.5 and you pay a 10% penalty plus income tax. The government has a key to that account and you don't get it until a specific birthday. $200,000 in your business valuation. That number exists on paper. It becomes real money only when someone buys the business. Until then, it's a number on a spreadsheet. Which leaves $67,000 in your brokerage that you can actually access quickly if something happens.
Trap 2, illiquidity. And this one hits the people who are actually doing everything right. Think about someone who owns 3 rental properties. Good investor, disciplined, the properties are appreciating, the rents are coming in, net worth looks strong, maybe $600,000 on paper. But after mortgages, insurance, property management fees, and maintenance, the actual monthly cash flow from all 3 properties is around $340. Not bad, but not a cushion either. Now, one roof needs replacing. $18,000. Suddenly. The wealth is real, $600,000, but the cash isn't there. The properties can't be sold in a week. The 401k has penalties. The home equity line takes time to access. And what should be a manageable problem becomes a crisis. Not because the person is broke, but because their wealth is trapped in forms that can't respond quickly. Illiquidity doesn't announce itself. It just shows up at the worst possible moment. The fix has 2 parts.
First, build a real cash reserve that lives completely outside of retirement accounts and outside of your properties. Not your emergency fund. Separate. Bigger. Think 3 to 6 months of total expenses minimum. Second, as you build asset value, build cash flow alongside it. Not just appreciation on paper. Actual money moving into your account every month that you control directly. Because liquidity doesn't just protect you from emergencies, it lets you move on opportunities when they appear. And opportunities don't wait for you to refinance a property. Trap 3, tax blindness. And this is the one that quietly costs more money than almost any bad investment decision. Here's the simplest way to see it. 2 people, same job, same income, $180,000 a year. One of them files taxes every April, sees the bill, pays it, and moves on. Never thinks about taxes between April and April. The other one works with a tax professional throughout the year, not just at tax time, all year. They're making decisions in August and October that affect what they owe in April.
Same income, same year. Person 1 pays $41,000 in taxes. Person 2 pays $26,000. $15,000 difference from the same money, not from earning more, from planning. That $15,000 invested every year for 20 years at 7%, that's an extra $58,000 just from not being reactive about taxes. Here's what tax blindness actually looks like in practice. You treat taxes as something that happens to you once a year instead of something you actively manage all year. You max your 401k, but never look at a health savings account. You have a side business, but you're not tracking every legitimate deduction. You hire a tax preparer in April instead of a tax strategist in January. The fix is not complicated. 1, max every tax-advantaged account available to you. 401k, HSA, IRA, all of them. 2, if you have any self-employment income at all, track every single legitimate business expense. Every one. Software, equipment, home office, mileage, it all reduces your taxable income directly. 3, find a CPA who talks to you more than once a year. The difference between a tax preparer and a tax strategist is the conversations that happen in the middle of the year before the damage is done.
Trap 4, concentration risk. And this one is interesting because the thing that builds your wealth becomes the thing that threatens it. Think about how most people actually create their first real net worth. They go deep on one thing. One company's stock through RSUs, one business, one industry they know well, one property they bought early. Concentration is how wealth gets built. That's not wrong. But at some point, the same concentration that built the wealth starts to be the biggest risk to it. Here's a real scenario. Someone who's been at a tech company for 6 years. They have RSUs that have vested. Their portfolio is now 80% in that one company stock because it's been performing well and selling felt premature. One bad earnings report. Stock drops 40%. Their $320,000 portfolio becomes $192,000 in one afternoon. And here's the part that makes it worse. They still work there. Their income and their investment are in the exact same company. If that company hits serious trouble, they lose both at the same time. The fix is a simple rule. No single position should be more than 20% of your total investable portfolio. Once anything crosses that line, start rotating it out. Slowly if you need to manage the tax impact, but rotate. You built the wealth through concentration. You protect the wealth through diversification. Those are two different phases. Know which one you're in. Trap 5, staying only in public markets. And I want to be clear, this is not an attack on index funds. Index funds are excellent. If you're investing in low-cost index funds consistently over time, you're doing something most people never do. But here's what happens as your wealth grows and your financial knowledge grows alongside it. Limiting your entire investment conversation to what shows up in a standard brokerage app means you're operating in one small corner of the total investment landscape. Public markets, stocks, ETFs, index funds, that's one tool, a very good one, but one tool. Real estate adds cash flow, appreciation, and significant tax efficiency through depreciation. Private deals, when you find the right ones, offer upside that public markets rarely produce. Alternative investments can generate returns that don't move in the same direction as the stock market, which matters a lot when the stock market drops. Think of your capital in 4 categories. Public markets for your liquid foundation. Real estate for cash flow and tax efficiency. Private opportunities for high upside positions. And alternatives for non-correlated returns. You don't need all 4 right now, but as your net worth grows, knowing all 4 exist and understanding how each one works, that's what separates someone managing money from someone building real wealth. The goal is not complexity. The goal is having the right tool for each job instead of using one tool for everything. Trap 6, bad deal flow.
And this one starts automatically as your wealth becomes visible. When you have nothing, nobody pitches you deals. Nobody sends you exclusive opportunities. Nobody remembers your contact information. But as your success becomes more visible, that changes. The deal flow starts, and most of it should never touch your money. Your college friend who has a business idea and just needs one investor to make it real. The family member with a real estate opportunity that's a sure thing if they can just get the down payment. The person in your network with access to a pre-IPO deal that's moving fast and only has 2 spots left. Here's the dangerous part. Bad deals come wrapped in the exact same language as good ones. Exclusive, limited, upside, time-sensitive, trusted source. Every single one sounds the same on the surface. The filter that protects you is simple, and it works every time. Ask one question. Would this deal still look good in 60 days with real research done and zero social or emotional pressure around it?
Most bad deals cannot survive that question. They depend on urgency, on relationship pressure, on the feeling of being included, on speed. Strip all of that away and look only at the actual economics, and the answer becomes obvious very quickly. The other thing worth saying, some people start taking deals because they like being in the room. They like being someone who does deals. That identity feels good, but it's an expensive reason to write a check. The best investors I've studied pass on far more than they take. That selectivity, that willingness to say no, that is the discipline. Not the yes, the no. Trap 7, relationship drift. And this is the most personal one, and the one almost nobody talks about, honestly. As your wealth grows, some of the people who were closest to you when you were building start treating you differently. Not always in an obvious way. Sometimes it's subtle, a shift in dynamic that's hard to put into words. Some become more comfortable asking for things, financial requests that didn't exist before. Some pull back, not because they're angry, but because they don't know how to exist in a relationship where the financial gap has grown. And they don't know how to say that, so they just get a little more distant. Some become very interested in your financial decisions, offering opinions about things they've never personally navigated. And some, the ones who were genuinely your people, stay exactly the same. Those are the ones worth holding on to. New relationships form too, and some of them are excellent. Builders, serious people, aligned values, real friendships that start at this level and belong at this level. But some new relationships form specifically because of the proximity to capital, and the skill of telling those two apart, that becomes one of the most important things you develop. Here's the simple framework for who to actually take financial advice from. People who have built what you're building or beyond it, not people who are still figuring it out. People who have zero stake in your financial decisions, not advisors who earn commissions, not friends who might benefit from your choice. And people who will tell you no when no is the right answer. The most valuable people in your financial life are the ones comfortable enough to push back. Everyone else, hear them, filter them, and make your own call. Here's what I want you to take from this. Most financial content talks about how to build wealth, save more, invest early, start a business. That advice is real and it matters. But almost nobody talks about what happens after the number starts moving. The traps that appear specifically because you're doing well. The mistakes that don't look like mistakes until they already cost you. The 7 traps are overconfidence, about what your net worth actually means. Illiquidity, when your wealth is locked and life isn't. Tax blindness, that hands money back to the government that you didn't have to give. Concentration risk, when the thing that built your wealth becomes the threat to it. Staying only in public markets when your options have grown beyond them. Bad deal flow, and the discipline to say no far more than yes. And relationship drift, the most personal trap.
You don't have to fall into any of them.
but you have to know they exist first. The people who build wealth and actually keep it, they think carefully before they act. They build structure instead of just reacting to moments. And they never confuse the feeling of doing well with the security of a properly protected financial life. Those are two different things. And knowing the difference, that's the whole game.